I have concluded in about 2 hours of being here that I'm probably the only one who doesn't know Assad. So it's nice to meet you. And thank you to Bruce Bruce Usher for inviting me here. I'm tasked, I guess, with the first off doing all this in 20 minutes, but also being both, I guess, Camilla and Dr. Sono in one, because I am a practitioner. But hopefully, I guess the goal here is to really do a little bit of industry context as well. I'll do my best on that front. I prepared, I feel like I could probably throw a lot of these slides out, so we're going to wing this a little bit as we go. And I highly encourage interruption and questions as we go and try to make this as interactive as possible, especially because we have the 20 minutes. So my name is Brian Murray. I'm the CEO of Shift Capital. And I'll read this because we just did it recently, but we're a solutions-based impact real estate group who takes an integrated approach to developing equitable, inclusive communities that thrive. So we are a certified B corporation who deploys development strategies in underserved neighborhoods that align patient capital with long-term community success to help catalyze shared prosperity, build wealth for the existing community, and strategically preserve affordability. Before I go into our current fund, I just want to frame us in a little bit of the kind of real estate ecosystem. And as I said, I didn't know we were going to have so many kind of expert impact people in the room. So a lot of them are actually in the room as well, and can feel free to call me out on what I put together last night. But I really try to just break this into a couple different pieces and buckets. The first is just general housing funds. And I kind of lumped together the workforce housing funds that are out there right now, the NOAA funds, or naturally occurring affordable housing funds, which we can talk about a little bit, and then kind of the more traditional housing funds, all into one bucket. And just again to frame, these are typically funds that are investing in multifamily assets, and the returns range from very, very mission-oriented, 2% to kind of low teens, depending on strategy. Examples, in addition to Jocelyn's fund, I have a housing partnership equity fund here, the Turner Multifamily Impact Fund, which is a workforce fund. So there's this bucket. The next bucket really falls into the community development institutional finance world and kind of crosses a lot of different sectors. So typically, CDFI funds are investing in businesses, small businesses, but of course they do a lot of real estate transactional work as well, and a lot of that becomes thematic, whether it's based off of investing in minority businesses or the creative economy or health-related real estate or businesses as well. And just quick examples are kind of LIST Creative Economy Fund, the Enterprise Community Loan Fund, the Reinvestment Fund does a lot of this as well. The third bucket is where we kind of sit in, which is place-based real estate funds. And these have kind of manifested themselves in the last probably 5+ years in a variety of different ways. And I put down just a couple different examples of where we're starting to see this more and more. There's a lot of talk about innovation districts. There's a lot of anchor-led institutions that are now taking a more active role in the real estate cycle. And then there's kind of local regional development groups, which is us. And then there's a lot of kind of TOD focuses. And these are a little bit more traditional in private equity. There are a lot of private-public partnerships here. So the return profiles are a little bit more on the risk spectrum in terms of when we compare them probably to the CDFI world. Just to frame the discussion, I did leave out social impact bonds. They absolutely hit real estate. I did leave out kind of the tax credit equity markets. Again, just to simplify things here a little bit. And then, shocker of all shockers, I tried to stay away from opportunity zones. If people have been to any type of conferences lately, it's all anybody wants to talk about. And I will just say that they are a tool that are that don't necessarily drive impact, but they can be a tool for impact. And we can certainly, if that's of interest, talk about that a little bit more. Again, thinking this is just kind of where we are. Our Shift Neighborhood Fund is kind of in this, towards market, towards evidence-based, kind of at market rate, and certainly intentional in our impact. Another good way to show it here. So let me just share with you this fund, which is our first fund, which is this place-based fund. We came at this when we first started with, I think, a little bit of frustration with with how impact investing in particular was interacting with the real estate space. And so when we talk about the housing funds and we talk about the CDFI funds, the question is, how does that money end up flowing into the neighborhoods? We still have extreme poverty at a zip code level. And when we looked at that world, we were seeing money get spread out all over the place. So CDFI spread their money out, tax credit deals, new market tax credits, low-income housing tax credits. They put a nice, bright, shiny building in the middle of a neighborhood, but then their incentive structure is actually to move out of that neighborhood. So they say, hey, this is going to be a catalyst for change in this neighborhood, but then there's no really follow through. And so we were really struggling with how does capital flow through lower income communities, specifically in cities here in the United States, and decided that we wanted to figure out how better to do that. So our theory of change really is exactly what I was saying, is to invest in a catalytic project, invest all around that project. We're investing prior to the kind of traditional development cycle, so we're investing very early in neighborhoods with extreme deep poverty. And then we're thinking about, okay, how do we include the community from the beginning? How do we include them in the process? How do we include them in opportunities for wealth building along the way? So that when we look back on a neighborhood like we've looked, as this has happened in New York and DC and Seattle and San Francisco and Boston, we're not saying, oh, we missed the opportunity to help this community build wealth and be a part of this process. So we do that on the front end. We do that at scale. And we do that holistically. So we're not looking at this as, we're not an asset class in a real estate group. We don't invest only in office. We don't invest only in residential. We invest place-based. So anything in this neighborhood. So we have about 1.5 million square feet of industrial in 2 neighborhoods. We have commercial and mixed use in an old business corridor that right now is really the opioid center of the United States. We invest in residential, and really, at the end of the day, as we like to say, we build boxes, but we're really investing in people and really trying to provide hope to a community that has really been left out of access in the growth of cities in the last probably 10 years. Just in terms of the numbers, we raised a $42 million equity fund. Someone, when I walked in, gave me a few teaser questions for this. Our funds, I would say that of the equity that we raised, about a third of that is coming from people who recognize that we're doing impact, but don't necessarily care about impact and see it as a strategy on the financial side. A third of our investors are very much mission-driven, but have a hardcore fiduciary responsibility. So we have 4 foundation endowments in Philadelphia that have invested in this fund. And then a third are truly, hey, we want to see as much impact as possible, and even if that means lower returns. So we're really diverse on the investor front. Wow, that's 20 minutes is quick. I'll just kind of hit some key points here. We're very much in the middle of this execution. We've got 11% unrealized gains year on year so far, and obviously are in the middle of a lot of development at the moment. One of the keys approaches that we're trying to take is really to be focused on outcomes of raising all ships in these neighborhoods. And we feel like that doesn't happen unless private, public, governmental sectors are working together, 1. And then 2, that we are really coalescing all of this different capital sources towards one common goal. So in the nonprofit space, we often talk about collective impact. We like to call it collective capital impact, but basically taking our work as a private sector real estate group, bringing in the philanthropic, the governmental piece of it, and then I think one of the big missing pieces at the table is really kind of the concessionary capital program-related investment world, which is probably a whole nother 20 minutes in of itself. Return set just for us, this is, we're looking to achieve kind of 17 to 20% net IRR returns. We'll end up with a portfolio of about 125 million and return 2 times greater of investors' capital. We are a 7-year fund. When we were starting out, there was no such thing as opportunity zones, where now all of a sudden everybody thinks about 10 years. Back then, everyone was trying to fit us into the 5-year bucket, and the best thing that we could do to go out in the market was to basically push that to 7. We are trying to build as much patient capital in this as possible, because the reality is, we don't know how long it's going to take to really start to bring this community up. We 7% returns, and we are kind of an 80-20 split. So again, pretty kind of classic private equity model. In terms of impact to date, we've created over 500 jobs in this neighborhood. We've really focused on hiring locals and local and building up minority contractors as part of our process. We've brought 500 jobs into this neighborhood. This is a neighborhood that has unemployment rates probably 4 times the city of Philadelphia, and the city of Philadelphia is the highest poverty big city in the country. A lot of them are creative economy tenants. 100% of our residential portfolio without any subsidies is at 60% of AMI or lower. AMI is adjusted median income, and it's just a tool that's used to determine kind of rental amounts in comparison to someone's income. All right, I did fly through that pretty quick. Good. So I don't have that much time. I just want to make one comment before I kind of open this up, and I know I kind of rushed through this a little bit. I think you were bringing up this comment in the international sense of deal flow, right, and project flow. And one of the things that I think is most enlightening for me, I wasn't a natural real estate person when I came into this space, and actually I was on the venture side, was that the real estate space has a larger challenge right now that I think has been brought to light by the Opportunity Zone legislation. And that is that we don't have a culture of failure. And I say that with all irony of who's in the Oval Office. But for most other people, it is a real true black mark out there. And real estate doesn't have a culture of failure like the venture world does. You fail in the venture world, you're right back up the next day. You fail in the real estate world, and you're done. And 98% of the time. And on top of that, there's been so much structural, institutional, racial issues in the banking community when it comes to real estate in particular, that Opportunity Zone legislation comes across, everyone's all excited about all this new capital. All this new capital gets raised overnight, billions and billions of dollars of funds that are sitting there right now. And they're all looking to say, all right, how do we invest in these neighborhoods, predominantly neighborhoods of color? And there's no developers that are there. And you know why? Because there's just not a lot of developers of color, and there's not a lot of women developers, period. And the Opportunity Zone world, I think, has brought that to light. Now, in the venture world, we can really all kind of build that up rather quickly. In the real estate world, it takes years. So it takes 10 years for a real estate developer and operator to get to a point where they can approach asset managers, family offices, others, and be doing large deals. And so we have a deal flow problem too. And I think it is a larger one that's really something that if, as a community, we don't think about ecosystem growing and growing fund managers and growing operators on the ground, I think it's going to continue to be a problem. So I'll stop there, and I've got 45 seconds for Q&A.
through the exits. What happens to the affordable properties when you exit
Yeah.
at 7 years and make the return and pay off your investors?
Yeah, so that is the impact question. So when we were raising money, everyone asked us basically, okay, so are you just accelerating gentrification, using that word, which is very loaded in many different ways. And on one hand, this is really deep poverty, and so that's one kind of component to that question. But the other is, what do we do when we exit? And so what has happened in all these neighborhoods is hey, we're trying to get 15 to 20% returns for our investors. We bought very, very low. But when we exit in 7 years, who do we sell it to? It's in all likelihood, who's out in the marketplace right now is someone who's going to buy it and say, well, I'm buying it because now I can raise rents a little bit more. The neighborhood's a little bit better. I can take this commercial space and I can make it residential. And so in the last year, we have been working to create the nation's first neighborhood trust. And so this is modeled after some of your work, some of the Housing Partnership Equity Fund, some stuff going on in other places in the country. And basically what it is, it's a nonprofit entity that is owned and controlled by the neighborhood, so the community members. But it functions like a real estate fund. And so right now we're actually deploying that with some early commitments from the Ford Foundation to start actually buying real estate in the neighborhood today, and really set ourselves up to be able to actually even exit our real estate as well. And that is a fund that will rely primarily on PRIs, so 2 to 4% returns, and ultimately any appreciation or cash flow that comes out of that fund, instead of it leaving the neighborhood, will be able to now, because it's controlled by the neighborhood, be able to be redeployed in that community in ways that the community actually decides how that money is going to get deployed. Somehow I have another minute, so any other questions? Right behind you.
Hi, Jocelyn Sanko, Soros Economic Development Fund within Open Society Foundations. Thanks so much. Probably a very basic question, but what's the alternative for these real estate assets? What would they otherwise do, or no one would be investing in these, is maybe the story.
Yeah, I don't want to generalize too much, because I think one of the things when people talk about scale of this, and I always say, well, every neighborhood is very, very different. And in these neighborhoods that we're working on, what I often say is I think there's really two scenarios for these neighborhoods. One is status quo, and we literally have kids walking by, people injecting themselves in their necks every day, and that just doesn't seem acceptable. And the other option is just pure on gentrification, meaning the way that neighborhoods typically kind of evolve, or excuse me, that's the wrong word, but certainly change, is small developers come in and start buying up things in this kind of very piranha type of way, all working not in conjunction, but to their highest and best use. And what they're doing is they end up extracting, a lot of them are buyers and flippers that extract value out of the neighborhood. And so, my argument is that the truth is there's not a lot of alternatives. If there are not strong nonprofit organizations on the ground, that are doing a lot of development, a lot of communities are really just totally disempowered on this subject. All right, thank you.
Thank you. I'm going to stand. This is not a commentary on any of my previous speakers, but I've been sitting for too long. I'm Merilyn Rovira from the Community Development Trust, and I feel a little bit like Forrest Gump because I hadn't even registered for this conference until Wednesday, and then last night Matt Sheedy and Assad called me and said, hey, we lost a speaker, can you step in? So I feel like, sometimes you're just at the right place at the right time. So thank you very much for that.
I'll just say I wish I knew that when I was coming up. I could have.
You could have. So what I was asked to do, and what I will do, is give just a little bit of an overview about something called the Low-Income Housing Tax Credit. This has been a huge driver of the creation of affordable homes in the United States. I have no slides for you, sorry about that. But just a step back, I mean, I think in my world, it's self-evident why affordable housing, and thank you to the speaker who said, don't think of affordable housing as some dark, gloomy, bad project in a sketchy neighborhood. But why is affordable housing important, right? People need a place to live. These are not people who don't work. These are people who work every day, who have children, who may not have children, who are seniors, but you need an affordable place to live, because if you're spending 60 or 70% of your income on your rent, which is obviously very important to have shelter, you don't necessarily have room for food, classes, medical care. So I think that that's very important, and there's been some very interesting educational studies about, people tend to stay out of emergency rooms if they're in a supportive apartment where they can have their services, where they can have their blood pressure monitored, all this kind of thing. And there's this interesting nexus now of hospitals and healthcare systems investing in affordable housing, because it's much cheaper to put somebody in an apartment, even for $1,000 a month, than it is to have them come into your emergency room 3 times a month. There's a great studies about how kids do better in school if they don't have to move every year. Imagine, your family's getting evicted because your landlord raised the rent, and you started 3rd grade in one place and you moved to another place. You don't have your friends, you don't have the continuity, you don't know what's going on. But so again, for families and family stability, and then certainly if you're paying, and sort of the rule of thumb is if you pay about 30% of your income for your rent, then you end up with money to do other things, to buy food, to buy your kids glasses, to have transportation to get to work. So that's sort of the setting for why is affordable housing important. And I think that some people think, oh, doesn't the government handle that? I'd say only in Austria. But we've heard that Microsoft and Amazon and Google are all putting in billions and gazillions and trillions of dollars. Isn't that going to solve it all? And I'd say the answer is no, it will help, and it will help in targeted markets. So in 1986, with the tax law changes, some very smart people came up with something called the Low-Income Housing Tax Credit. This is a federal tax program. And with these tax credits syndicated, there was a huge amount of money that came into affordable housing. I was working for the city of New York at the time, and people from LISC came and said, gee, there's this crazy new thing, and we think we might be able to bring 25, 30% equity to these deals. Now that number is probably 60 or 70% equity, and this has just been a huge driver of that. So I won't go in. It's a complex federal program that's allocated by the states, but it has produced about 3 million units. Matt, is that right? It's a huge number of units, and they have affordability for a minimum of 15 years. California said 15 years isn't long enough. We need 60 years. States can do what they want. And states can have priorities. States can say, we're going to give a preference to people that put in applications that are targeting homeless, veterans, special needs, seniors, whatever it is that they need, they can spread them around in the state. But you've got a lot of pieces on this, and you can end up still with some subsidy, either federal subsidy or state subsidy, and you can end up with a little bit of debt, which is where banks come in or other folks to create this. So, like any good affordable housing project, you have almost as many sources of financing as you do number of units. We try to make it bigger than that. But that's sort of this program that's been going on for a long time. And as Matt suggested, this has been a way for a lot of domestic impact investors or CRA investors from banks to get into this. And there's been some very positive impact, right? People have a place to live. The best ones are near transit. The best ones have green. The best ones have social services. That is a little bit of an overview on this very advanced market. I'm going to talk now about my company, which is the Community Development Trust. Thank you, Brian, for setting it up, because we're an unusual structure. And whereas Brian has got sort of market rate investment helping to stabilize Kensington and what that's doing, and that might be backfilled by foundations and this neighborhood trust. our earliest incarnation was as a nonprofit. We had a PRI from the Ford Foundation. Metropolitan, through their foundation, came in and said, gee, we like to think what you're doing. And we started, and we had a really good credit compass. We were a secondary market for community development loans. We thought, oh, loan funds around the country would lend money if they had a secondary market in which to sell it. But while we had a good credit compass, we felt like we couldn't really grow and have the impact that we wanted to have without a significant amount more capital. And in the sexy things that foundations got to look at to put their capital in, we were really, really, really low. So we thought, all right, how are we going to do this? And we had the idea to take a technique from Wall Street, which was we were going to become a for-profit, mission-driven company. We elected to be taxed as a real estate investment trust. And we were going to go out and do what we had been doing. Providing a secondary market for community development loans, but also investing traditional equity, not tax-advantaged equity, to preserve these units that had been created under the low-income housing tax credit. So in 1999, we raised our first common shares. This was not a fund. This was investment in us corporately. Deutsche Bank, Metropolitan City, some of those folks came in, and they're still with us. Since that time, we've raised about $300 million in capital that we have used to preserve or create tens of thousands of units, about $1.6 billion worth of real estate, and having a positive impact on about 125,000 people. So we raise capital, we're lucky we're a CDFI, but we raise capital through the issuance of preferred stock these days. We had a capital raise last year, went out to raise $50 million, we raised 85.5, but we're finding so many good properties that we can preserve that we're going to be going out probably again this year. And the one advantage that we might have as a fund, we don't have a timeline when somebody tells us to sell the property. We have the first equity investment we ever made in 2001. At a certain point, that's going to need more than a small repair or a little bit of a refresh. It's going to need a gut rehabilitation. At that time, we can sell that property, take our market value, and go somewhere else. But we have a very elastic time frame on how long that we're able to keep the properties. I'm envious about a very place-based approach. It must be very satisfying to walk down the street and see all these things. We like to say we're opportunistic. We have a lot of units in Austin, Texas. There's a very entrepreneurial housing authority there. And together with that housing authority, we bought a 4-year-old market rate apartment. We put it in a single asset entity. We deed restricted half of those units. The city of Austin gave us a tax abatement for the whole property. And really within 4 months, we had 335 units of affordable housing, which, you know, the real estate cycle, that could be 4 or 5 years. But we've done that several times with Austin. So we've got a flexible model on what to do. And we track our impact very carefully. It's not necessarily something that you're going to see on everybody's, you know, the sustainable development goals are great, but they don't talk about shelter. They talk about poverty, they talk about some other things. So we just decided, okay, what's important to us to know about these properties? Income, AMI bands. A surprising number of our units are not just at 60% of AMI, but target deeper than that, 30% of AMI. So AMI in New York, $60,000, so 30% of that. We have substantial percent of units in our portfolio that could be affordable to somebody making $18,000 a year. Right, we also have toward the other end of that. But we look at what's the access to schools, what's the access to transportation, what are these kinds of things, because we want to understand what we're doing. So I thank Assad and Matt for inviting me to speak here, and I'd be happy to take any questions. Or not. All right, thank you very much.